Okay, so here's class 8. We want to continue on with our discussion of annuities. And I want to cover a couple of articles I think you'll find interesting. It does give you some great insight into this industry. So 2 articles on annuities. In addition to the articles you're doing for paper 1, I think you'll get a good rounding in this industry, and especially in interviews, have a good understanding of how this product works. And then we're going to start the mathematics behind equity-linked annuities. It may take us a little time because to explain equity-linked annuities, we have to have a good basic understanding of options, of stock options. And so we'll spend a little time refreshing you on that. Or some of you may have never studied stock options. So we'll do the basics on that, and we'll have to do that before we can really get into equity-linked annuities. So continuing on with what we covered last class, so we talked about this before. Life insurance and life insurance industry has annuities for both the accumulation and payout stage. Remember, other industries like banks, investment firms, they only do accumulation annuities. They only have annuities where you build up a balance, a savings account over time. And then if you want to convert that into some type of pension plan, some type of annuity, you would have to put it in a life insurance company and have the payout come from there. So the life insurance industry is the only industry that can do payout annuities, with the exception of company pension plans and Social Security. So with the accumulation product, you really don't need a life insurance company to do this. We'll talk in the second article on annuities. You'll see how this one gentleman found a way to take advantage of the life insurance industry and the way they do their accumulation products. But generally, it's just a savings account. And so if you die, there might be a death benefit, but oftentimes a death benefit is simply returned to you whatever your current balance is. We'll see with variable annuities, there is some actual protection there. For most actuaries, with the exception of 2008, and we'll see that with the exception of 2008, the death benefit on annuities really is not a big part of what the actuaries are pricing or concerned about. So the death benefit might just be what your cash balance is, what your balance is in the annuity. They do have advantages. So if you think about Roth IRAs and traditional IRAs, we'll talk about here in a little bit in the taxes, they have a bigger tax advantage than life accumulation annuities. I mean, life has the same advantages, but the traditional deferred annuity that's not in Roth IRA or traditional IRA doesn't have the same advantages of those structures. However, you can put much more money into these type of products. So when we talk on the tax side, there are advantages to the life insurance industry. They can do the traditional Roth and Roth IRAs, but they can also do additional deferred annuities, which have huge tax advantages. So that's the accumulation. Really nothing special there other than it's just another way to save money for retirement. The payout, I think, is where the interest is, and you're definitely spending a lot of time in paper 1 talking about the payout annuity. I gave you 2 articles on that. So there's different ways you can structure it. There's one that's a life annuity. It pays out until death. It is possible that you have a period certain. I'd like to, when we get to pricing, show you the difference between a life annuity without period certain and a life annuity with period certain. What period certain means is someone's worried that they give a lot of money to a life insurance company, and that company is going to pay them, say, $500 a month until they die. So maybe they give the company $300,000, but they're worried, what if I die tomorrow and I gave them $300,000 and I get nothing and my estate gets nothing? So I want to make sure that, hey, if I die, I want my estate to at least get 10 years of that $500. So I want a period certain of at least give me 10 years. Now, the advantage of that is if you die tomorrow, at least your estate will get some of that $300,000 back, and maybe even all of it, just not interest adjusted. The downside of it, and that's what I want to show you in class, in a future class, is if you have a period certain, it will definitely reduce the monthly income you can get. So like with my mother, if we do a life annuity with her, a payout annuity, I'll probably just do one without period certain to get her the highest income possible. But we'll see. We'll have to look at the different, if one's $500, but with period certain is $480, then yeah, just do the period certain. You're not losing much. But if one's $500 and the other one's $350, there's a big difference. And that if you're healthy, you really think there's a good chance you'll live more than 10 years, there's just a slight chance you'll die early and lose some of that money, then the period certain might be a bad decision because how much it will reduce your monthly income. So temporary life, we won't cover that. I don't know anyone would want that structure. But so any kind of guarantee you have on some kind of minimum, that minimum number of years or minimum number of payments or dollar amounts returned, the more guarantees, the less you'll get in an annuity. If there is no life contingency, so essentially they're just saying, we'll pay out, and if you die, whatever balance is left goes to your estate. That is not life contingency. Now, life insurance companies do have structured annuities without life contingency. So they pay you $500 a month for 20 years, and if you die in that 20 years, then whatever is left goes to your estate. After 20 years, it stops paying you. That's not a life insurance annuity. That's just like a certificate of deposit or any other just investment. You don't need actuaries to do that. Even though the life insurance industry does sell these products, it's really about the furthest thing from life insurance that they have. They're just pure savings products. Just a definition here at the bottom, the annuitant is the person whose life governs how long the annuity lasts. So it's possible the annuitant and the person receiving the cash could be different people. But you want to ask, when does the annuity stop payment? Well, whenever the annuitant dies, and so the annuitant is that key person that is life contingent. Now with annuities, just like with life insurance, there is some anti-selection. People who think they're healthy are going to live a long time. They're more likely to buy annuities than people who are unhealthy. Just like with life insurance, people who don't think they're healthy, don't have long longevity in their family, they're at risk of dying early, they are more likely to buy life insurance and less likely to buy annuities. And actuaries know this. And so they have different mortality tables for life insurance and different mortality tables for annuities. Now, mortality table is the table, we'll see it later when we price insurance. It's a table that tells you how many people you think will die at different ages. But if you looked at a life insurance mortality table, people die faster in that table than they do in one for annuity. So they actually charge you more from the simple fact that you buy an annuity. They say, oh, that means you must be healthy, therefore we will charge you more because you're buying an annuity. There's not a lot of underwriting done on annuities. The insurance company doesn't have you do tests to make sure you're not really healthy. They just assume that if you buy an annuity, you are healthy. Unlike life insurance, they'll have you fill out an application, they'll have you maybe take a blood test or other medical exams. Just because anti-selection is more possible with the life insurance. It's possible someone doesn't think they'll live a long time, but they haven't had a medical exam in a while, and the insurance company says, hey, you have to get an exam, you have to have a blood test. We want to make sure you're expected to live at least another 5, 10, 15, 20 years. And so that's the way insurance works. People who die early with annuities, people who die early subsidize people who live longer. For life insurance, is those who live the longest, they subsidize those who die early. Both of these have anti-selection. Both of them have mortality tables. Now, when we do mortality tables, we'll be using a life insurance table, but we'll be using it to price some annuities. So I'll be making a mistake in doing that, and I'll have to explain that when we get to it. How material that is, maybe I'll do some math using a different mortality table if I can find some. It's hard for me to find them because a lot of these tables, they're not easily available, especially the ones that actuaries actually use to price these products. Now, one question I have asked, and getting back to this slide, one question I have asked actuaries, and I've never gotten a good answer to this, but what if someone owns both a life insurance product and an annuity with the same life insurance company? So maybe they're retired, so they annuitize some money. So maybe their spouse died and they got a life insurance policy and they use the proceeds of that to buy a payout annuity. But they also have a life insurance policy, so when they die, it will pay for their estate taxes. So they both have a life insurance policy and an annuity. And so what I ask the actuaries is, there's no way they can die early and live too long. So it seems like if the actuary tables are penalizing them because they buy life insurance, and therefore you think they're going to die early, more on average than more than the average person, and you're going to give them less for the annuity, because if they buy the annuity, you think they're going to live long. They can't both die early and live long. It seemed to me, if someone has both of those products, you should give them some type of pricing break, and give them more of an average table, which will reduce the premiums on life insurance and increase the payout. Actuaries just look at me like I'm out of my mind, but I think it's a legitimate question. Okay, some classifications of annuities, and let me just tell you, there's more than this. I remember when I started in life insurance, especially on both on the, I was on the expense management side and on the accounting, financial statement accounting side. There are so many terms. And the reason for that is there's terms that the accountants use, there's terms that the actuaries use, and there's terms that you need for tax purposes. And you'll see different terms. So the same product could have 5 designations in one way and 7 in another, and there may not be any overlap between the two. So I'm giving you a very high level generic description of these products. So one way you can look at them is you have individual policies and you have group policies. And the group policies are usually provided by an employer. USA's 401k plan has something called a fixed option. And that fixed option gives you, it's like a bond fund, but with guarantees. So it doesn't quite give you the return of a bond fund, because they have these guarantees that says you can never lose money. And the way they set these up traditionally has been to buy group annuities from life insurance companies. And that way they can guarantee a rate. Most 401k plans have moved away from the life insurance industry. They can get these products better deals from investment firms like BlackRock. But there are a lot of group annuities that were sold to 401k plans. But individual annuities and group annuities. The other thing another way you can classify annuities is very similar to what we did with the life insurance, is you introduce this word variable. So annuities can be fixed. The fix is a lot like the universal life, where it's not one rate for the entire life of the policy, but the rate can change. And here, both of these on this one, we're very much talking about the accumulation phase of the annuities. We're not talking about a payout annuity. Once an annuity goes to payout, it's essentially, they're all fixed. But during the accumulation phase, it could be fixed. By fixed, it doesn't mean you get the same rate every month. What it means is, like a universal life, you're getting a rate that will change slowly over time as interest rates change over time. But it will never be negative. It will just be 5% one month, maybe 4.5%, 4.75. It will generally move with interest rates, but not as rapidly, because companies are buying 5- and 10-year bonds, and so they can fix in that rate. Versus variable annuities. We'll talk a little bit about variable annuities when we get into this article. But they're just like the variable life insurance. The policyholder decides what investment risk they want, and they can point that annuity's investment to those particular variable products, so mutual funds. And because these products are essentially investments, the company must segregate the assets, just like we said with life insurance, variable life insurance. And they are SEC and state regulated. So the SEC does regulate variable annuities just like they regulate variable life insurance. So variable annuities provide a death benefit, and we'll talk about that when we do the article. Essentially what they say is, if you die, we will return your premiums back to you, maybe your premiums plus some investment income. That can be huge in a year like 2008 when the stock market falls 35%. And let's say you die and your portfolio, maybe you gave the company $100,000, and then at the end of the year you die and you had your money in a variable annuity tied to the stock market that's down 35%. So your $100,000 is now only worth $65,000. But since you died, the insurance company will actually give your beneficiaries $100,000. So there is some insurance there. We'll talk about how risky that is when we get to the article, and you'll see how someone took advantage of that to try to get some upside potential without any downside risk. Another way you can classify annuities is immediate versus deferred. So an immediate annuity is a payout annuity. So that's another way of designating a payout annuity. It's an immediate. What that means is you give money to the company, $300,000, and they immediately start paying you a monthly income for the rest of your life. That's an immediate annuity. I don't think there's a real distinction between payout annuities and immediate annuities. Versus a deferred annuity. A deferred annuity is another way to talk about accumulation annuities. That means the annuity is deferred. So you can see the word annuity has gotten a little bit mixed up. To me, an annuity is when you have a monthly income that's being paid to you, a regular amount, same amount every month for the rest of your life. That's an annuity. The word annuity has gotten confused in the tax code because the tax code talks about annuities, which is really you're saving money so that you can have an annuity in the future. So we call it a deferred annuity. Essentially what that is, an accumulation product. You'll save until retirement, and then you'll convert that deferred annuity into an immediate annuity. If you remember the Doña story, she had a deferred annuity, and then she turned 70 years old, and what her agent should have done is he should have converted that deferred annuity into an immediate annuity. There would have been no tax consequences other than she'd have to pay a little bit of tax every year on whatever the payout was. So that's an immediate and deferred. Another way of thinking about payout annuities and accumulation annuities. Another way you can distinguish annuities is single premium versus installment. So single premium can be both a deferred and immediate annuity. You can actually pay a company $500,000 today, say at age 25, and it won't mature until you turn 65. So that's a single premium annuity, but it's deferred. And you might hear that referred to if you interview with an insurance company, and they may call that an SPDA, a single premium deferred annuity. It's an accumulation product, but you only pay one premium. Now, why might you do that? It might be husband and wife, and one spouse dies, and they get $200,000 in life insurance, but the spouse that's living is not old enough to retire. They don't want to pay out annuity yet, and so they'll just put that $200,000 into another deferred annuity and just save up until they retire. So that's an SPDA. Most SPDAs are funded by a life insurance policy on a spouse that's passed away. And then you have installment annuities. These are going to be deferred. That's where you're paying a monthly income, a monthly payment premium to the insurance company. And then when you retire, you stop making the premium payments, and they start making you annuity payments. It really wouldn't make sense to pay the insurance company $500 a month and they pay you $600 a month. So you do the installment payments for the deferred annuity, and then it becomes an immediate annuity, and you stop making premiums. So an installment annuity is always deferred. It's an accumulation product. So an SPDA is an accumulation product with one premium. You can have a single premium where it's an immediate annuity, where you pay them a premium and they immediately start paying you money. That again is usually provided by a life insurance proceed from a spouse. Another way to break up annuities is to compare single annuities to joint life annuities. So a single life annuity, there's only one life that depends on. When that person dies, everything stops. A joint annuity, it could be first to die or second to die. Most of them are probably second to die. So it pays $500 a month to this married couple. If the first spouse dies, then it keeps paying money until the second one dies. Now, it's possible it could be first to die annuities, so it stops paying the annuity when the first to die. That might happen because you'll get more money if you do that. You get a higher monthly income. Why would you do that? Well, if one of the spouses has a huge pension plan, and so you're living off of their pension plan plus this immediate annuity, but if he dies, or if it's on the husband, if he dies, then there's life insurance in his life, but his pension stops. He'll get all this life insurance. They may say, you know what, just stop all the pensions, and we'll just create a new annuity off of that life insurance. So there may be a reason. Most joint life, though, is going to be on the second to not die. And then a pure life annuities, that's one where you have no payment certain. So once the person dies, even if it's 3 minutes after they buy the policy, there are no more payments. Versus a period certain, if they die, the beneficiaries continue receiving the payments. There may be a refund feature that says, well, at least you'll get your initial premium back. At least, if you paid $100,000 in, your family will get at least $100,000. When you adjust that for time value money, it really won't be that much because they'll be won't be earning any interest on it if it's just a pure refund, but at least you get some money back and you don't worry about it. And you saw some of that in your discussion for paper 1, why some people don't buy annuities. Is that fear that they'll die too soon and they'll lose all the money that they invested in the annuity. Annuities can also be specially structured to be market value annuities, MVAs. Now, MVA, rating agencies love MVAs. Life insurance companies have huge risks. We talked about that when we talked about disintermediation. With disintermediation, people were taking money out of life insurance companies and moving them to banks. This is also true with annuities. If life insurance companies are paying 5% and banks are paying 7-8% on their CDs, then people will take money out of their annuities and move them over to the bank. What an MVA does is says, okay, if you want to surrender early, that's fine. However, we have this index that says, hey, if interest rates have risen this much, we get to take a huge surrender penalty off of your money. So essentially, they take away all the advantages of taking money out of the life insurance company and moving it to a bank. And you can see why rating agencies would really like that. Rating agencies are very concerned that life insurance companies will have what we call a run on the bank. That is, a lot of policyholders want their money out at one time, maybe because interest rates are higher somewhere else. So market value adjusted annuity, regulators say, hey, if you have that, rating agencies say, if you have that, then we're not as worried about you going insolvent than if you didn't have that. When I worked at UTSA, I never saw an MVA. I don't know if they do that now, but they didn't, but there are some companies that do. Then you get into an Irs classification where the annuity is qualified or non-qualified. So qualified are the traditional IRAs and the Roth IRAs that they're specifically in the tax code. A traditional IRA gives you an immediate deduction. So if you put $5,000 into the annuity, you get a $5,000 deduction from your taxable income. And all the investment earnings are tax-free until you retire. Now, when you retire, it's taxable. Your initial investment is not taxable, but any investment earnings on top of what you initially invested in the annuity is taxable. So traditional IRA gives you a tax break today, tax deferral, but then is taxed in the future. A Roth IRA and even a Roth 401k, which your company may provide you, and you definitely should look into Roth 401ks as an alternative to the Roth, to your traditional 401k, or at least some of your money, or the additional, look at it and carefully think through it, run some scenarios. But here you get no tax deduction today, but you do get deferral of the income, and even when you retire, it's non-taxable. So it's perpetually non-taxable. Now, I think the risk here with the U.S. government debt's so high, they can always change these tax rules. So I think one risk, people in their 20s taking advantage of Roth IRAs. I agree, the statistic analysis, the analysis that's done, some of the models run, Roth IRAs look a lot better than traditional IRAs, But that's assuming the tax code doesn't change in the future. And so that's always a risk that they might make some of it taxable because they just have so much they got to cover. So who knows how these will play out in the future. But Roth IRAs, especially if you expect the stock market to make 7, 8, 9%, you'll be deferring a great deal of investment income. And that will be tax-free the rest of your life. That's a pretty nice feature of a Roth IRA. I do have a Roth IRA and not a traditional IRA. So no deduction, but with deferral. So other type of annuities outside of what the IRS allows, that's what you get. No deduction, but you do get deferral, but you are taxed when the money comes out. So that's the advantage the life insurance has over the traditional IRA and the Roth IRA is you can put a lot more money into them. There's not these annual restrictions on how much you can contribute. So you still get the deferral, and the deferral is really nice. I have a few deferred annuities that are paying really good rates because of when they were set up. And the rates have come down to the minimums, but they still have really good rates even after that. And I'm just keeping them. If I took them out, I'd have to pay a tax penalty. But I'm just keeping them. Maybe when I turn 62, 63, I can take them out without the tax penalty, maybe roll them over into something else. But the deferral, even with the fact that interest rates are low, the minimums were so good. If you adjust for the minimums and the fact that I'm getting tax deferral, they're actually a really, really good investment. Much better than I can do with anything else out there at that risk level. All right, we're definitely going to talk about equity index annuities. We're going to talk about them theoretically, talk about why the federal government has not regulated them. They're a good example of contrasting them to variable products and why the government does regulate variable products. And then we're going to get into the math. I'm going to show you how to actually build your own equity-linked annuity yourself, something that's really easy to do, actually. So these products were introduced in 1995 as a way the insurance company to find another way to get customers to buy products given a strong U.S. stock market. So insurers are branching out of their traditional actuarial dependent products. So this is a product that it's a lot like a variable annuity where there's not a lot of actuarial support. A variable annuity has more actuarial protections than an equity-linked annuity, and we'll see that when we cover the article. But we're seeing less and less insurance involved in these products. But equity-linked annuities are not regulated by the SEC. They're not clearly an investment product. But the SEC has definitely been looking at these to regulate them. Now, I do think they are an investment, mainly because the policyholder could create these exactly the same way the life insurance company is doing by combining an investment and a derivative. And you'll see how we do that here when we actually do the math. Most consumers don't know how to do that. And these products, it's not quite like a variable annuity, because a variable annuity, you put your money into a mutual fund, and whatever that mutual fund makes, that's what you return. It's passed through. For the equity-linked annuity, the life insurance company makes payments, but they make investments, excuse me. They make investments, but they don't pass through whatever they make to you. Instead, what you get is based entirely on the formulas set up in the policy. So it's possible the life insurance company will make something slightly different than what they pass on to you, but I can assure you they are going to set up these products so that what they make is what they pass on to you, even though it may not be an exact perfect pass-through. What I think is another problem with these products is the marketing practice. You see this advertisement, the returns of the stock market without the risk. The guy I talked about that was telling me about these products a few weeks ago, he was using that argument. You get the upside, but you don't get the downside. I don't agree with that, and we'll talk about that a little bit more. Very complex. Remember that when we talked about the article on equity-linked annuities, the participation rate and how complex that was. So let's talk to SEC. We're about halfway through the class, so if you want to hit pause right here and go get something to eat or drink, stretch, pet the dog or whatever, take a break for a few minutes, and I'll breathe here for a couple of seconds, and then I'll be ready to go again. All right, so we're on page 29 of the class notes. So the SEC, should they regulate this product? In my opinion, if they regulate variable annuities, they should regulate this product. Now, I guess you can get into the bigger debate if the SEC's regulation is really of any value. So I'm not going to get into that libertarian debate. I have my own opinions on that. But my point is, if they regulate variable annuities, there's no reason they shouldn't. But why doesn't the SEC regulate insurance products? And it's because insurance companies have been given this safe harbor, Rule 151. And what the SEC says, if your product falls under this safe harbor, you are free of any SEC regulation. So what are the requirements? The first requirement is your firm must already be regulated by an insurance or banking regulator. Well, for an insurance company, that's true. Every insurance company in the U.S., even foreign insurance companies, are regulated by the state governments. So every insurance company selling an equity annuity would fall under this requirement. So that's not an issue. The second one is there must be an allocation of investment risk to the insurance company. It can't just be passed through. So I talked about with variable life insurance, variable annuities, whatever the mutual fund makes, that's what the policyholder gets. So the question here is, how much risk is a life insurance company doing? And again, it's not a perfect match, but it's a very, very close match. It sure looks like the insurance company is passing through this return from the securities that they purchase. And that's because insurance companies really cannot risk too much of their capital, betting on stock markets, letting there be any noise in this. Now, some of the risks they may be taking is they're buying bonds that could default. That's very different than variable annuities, where if you buy a bond mutual fund, and one of the bonds in the mutual fund defaults, that's going to be passed on to you. But if you buy a deferred annuity, fixed annuity from a life insurance company, and they take your premium, put it into a bond, and that bond then defaults, you will not take that risk. The company will. So there probably is, from that standpoint, definitely some risk the insurance company is taking. But the stock market piece, how they're getting you the stock market, that is essentially going to be a pass-through from them. There should not be token guarantees. The insurance company does provide some guarantees, like guaranteed minimum returns. So that's probably an argument they can make that this is not an investment. And then states have minimum crediting rates, and equity annuities do meet those requirements. So equity annuities probably meet the letter of this. Whether they meet the spirit of this, the way these are structured, that would be a debate. A third requirement is marketing. And this is probably the SEC's main concern. Is this product marketed as an investment, or is it marketed as insurance? And I don't think there's any question whatsoever that these products are marketed more as investments than as insurance. So if they're marketed as an investment, the SEC has the right, not the requirement. So this doesn't automatically mean that they will regulate, but it certainly gives them an argument to. And this seems to be where they're most looking at this product as the sales pitches. And remember, the SEC was going to regulate these products, and at the last second it was taken away from them. So how are the sales pitches made? What's the training of the sales force? How does the company monitor their sales force? Remember, a lot of these products are sold by sales agents one-on-one, without any video recording going on, without anyone knowing what's going on. And there's some questionable ethical behavior going on. What distribution channels are used? Are they using traditional insurance distribution channels? Or are they using a channel that also sells a lot of variable products and investment products? What's the main competing product to equity annuities? It probably is variable annuities. And so from that standpoint, since variable annuities are regulated, equity annuities probably should be regulated. And then requirement 4, this is not actual requirement, is simply something else the SEC looks at, is there any mortality risk? So that means if you die, what will you get? Is there any kind of protection that well, given that there's no downside on this, there's really no need for a guarantee because it's part of the product. This way it's structured. So if you die, your estate will get your premium plus interest. That's just the way it's structured. So it's not really mortality. It's not really life insurance. It's just simply returning your money to you. So those are the requirements for something to be regulated by the SEC. Before I get into an update on the SEC, let's real quickly to tax treatment. So the Pension Reform Act of 1974, what the IRS is trying to do is help people who did not have a traditional pension plan. So if you weren't covered by a pension plan, you can deduct, and these are old numbers. I don't update these. If you want the current numbers, I'm over 50, and so I get a little extra. Actually, these numbers look really, they've been jumping around, and they had gotten really high one year. There was a catch-up year, so I don't think these numbers are really that far off. So how much you can contribute to a traditional IRA? Same thing for a Roth IRA. If you're covered by an employer plan, you can contribute some, but it's a decline depending on how much you have in those plans. Distributions are taxed, so that's traditional IRA. So your insurance company will have to distinguish between what's the taxable portion and what's the tax-exempt portion and the taxable portion. And that's a good reason to rely on your insurance company because that's going to be really hard for you to calculate yourself. Distributions can't start before age 50, or there's a 10% tax penalty, but they must start at age 70 and a half. So you're not allowed to start taking distributions too early, and you have to start. So the IRS did not want people using this to shield income for the rest of their life. And if you look this up, these are actually quite simple. When you annuitize these, you start taking money out. There's IRS tables that are very straightforward, and they tell you exactly how much you must take out when you turn 70. You don't have to take the whole thing out, but they'll look at your life expectancy and they'll say, okay, you're expected to live 16 more years, so you need to take 1/16 out this first year. The next year they look again and they say, hey, your life expectancy is now 15 and a half years. So you got to take 15.5% out. So as you live another year, you're expected to live more. So your life expectancy doesn't go 16, 15, 14, 13 years. The fact that you lived another year means you're more likely to live maybe 15 and a half years, or maybe 15 years, 2 years out. So the tables do that, and they're very easy to read. It's actually not that complicated. The hard thing is what is the taxable portion and what's the non-taxable portion. But how much you must take out, that's actually pretty straightforward. A Roth IRA, same rules. Essentially, the only thing is you do not have to take out money starting at age 70 because IRS doesn't care. It's all tax-free, so they don't care if you leave it in there forever and ever and ever until you're 95. You can invest in just about anything that meets qualified plan requirements, except for you cannot put life insurance into a Roth or traditional IRA, and you would not want to do that because those are already very tax advantaged. There are rollover possibilities. I don't know those rules. One thing I will say is rollover is really pretty easy to do because remember these industries, they want your money. So if you need to do a rollover and you're not sure how to do it, you can usually just call the company, tell them what you want to do, and they'll say, just send us everything and we'll work on it. So they'll help you out, especially if you're talking over $100,000. They want your money. They'll definitely help you do all of the paperwork. All right, so before we get into equity-linked annuities, page 30, it talks about how do you compare different deferred annuities. So the things you need to compare, it gets pretty complicated, but you have to look at surrender features. So surrender features are you put your money into the annuity and a year later you say, you know what, I changed my mind, I want my money back. Well, the surrender penalty could be 12%. So you give them $100,000 and then you say, you know what, this company is a little shaky. I don't think I should put my money with them. So a year later you say, give my money back. Well, you give them $100,000, they may only have to give you $88,000 of your money back. So look at those surrender features. They usually decline over time, so it might be 12%, 11%, 10%, 9%. There's one lady I was helping with her surrender features, and we actually asked them to send us a check. This is for life insurance, not for annuity. They sent us a check, and the amount made no sense. So we did not cash the check. We sent it back, and we said, you took out too much. They said, oh, sorry, that was a mistake. And so they sent her another check, and they took out the exact same amount. So we called again, and they said, sorry, but your policy changed, and we just need to send you the updated policies. So I said, well, I don't know how you can change the contract, but send us a new contract. They sent us the contract. It was the exact same contract we had. So I had to call them again and say no, and they finally figured out there was some kind of error in their system. Fortunately for us, during that time, the person whose life was being insured got diagnosed with cancer, so she decided just to keep the policy and not surrender it. But they took so long and it was so complicated. So you can see you really have to be careful with life insurance companies. Some of them have very old legacy computer systems, and boy, the mistakes are just amazing. The second thing to look at is their crediting rates. What kind of rates do they pay? You can't just look at the current rates and say, wow, they're paying 0.5% better than everyone else. You need to look at their history if you can. There's a such thing called bait and switch, especially at certain times of the year. When the insurance company knows people are paying closer attention, they'll push their rates up very high at that time. And then once that period of extra scrutiny is over, they switch back to their lower rate. Now, a lot of companies do that. What's their guaranteed minimum crediting rates? I've seen from some annuities that was huge. The annuities I bought in 2008, they had very high minimum crediting rates. I don't know why. I asked the actuaries, why are y'all doing this? You know, these 3.5% minimum rates. That just seems crazy to me because the 10-year treasury was getting really low. And so now you look at it, you have a 3.5% guaranteed minimum rate when the 10-year treasury now is well below 1%. That's a tremendous guaranteed minimum rate. Some of these products in the early 80s, they had guaranteed minimum rates of like 5%. I remember at UTSA, they had over $1 billion in annuities with 4 and 4.5% guaranteed rates. And they're trying very hard to get their customers to switch out of those products to other products because those minimum guarantees were just they were at the minimum guarantee in almost every product because interest rates had fallen so much. And then administrative expenses, what kind of charges will they charge you? And that can sometimes be hidden in the footnotes. We saw that with the equity-linked annuities. So if you're trying to compare annuities, it is easier to compare than with life insurance. There's not quite as many bells and whistles, but we saw with equity-linked annuities, some products are very, very complex. All right, so let's do a couple of articles. This first one is one of my favorite products. When we get to pricing life insurance, we'll definitely talk about it. I actually at UTSA tried to create a new product that I wanted to get patented, and I'll show you that new product when we talk about longevity products, exactly what I wanted to create because I think it would have been wonderful. The president of my company, of the investment company, he was head of both the investment company and the life insurance company. He thought it was a great idea. He said, let's do it if you can convince the actuaries. The actuaries thought it was a stupid idea, so I didn't get anywhere with it. But here's an article talking about longevity annuities. I do not like the way this article does it, and I'll show you my approach when we get to it. And actually, usually on the final exam, I have a really strange product that's a longevity product. It makes you have to really use everything we learn about pricing and put it all together. But I think they're a great product. So what is a longevity insurance? It's essentially a way to protect you from living too long that does it much better than an immediate annuity. Immediate annuity, you buy it today and they immediately today start paying you money. The problem with that is what you get back versus what you pay in is not anything close to what you get with life insurance. So essentially what I want you to think about with a longevity annuity is think about the parallel with life insurance. With life insurance, you buy a product so you pay $50 in a month, and if you die, you get $500,000. Now, if you live to be 95, that was a really bad product. You pay $50 a month forever and ever and ever, and you made it to 95. But if you die, 1 year later, that's an incredible payoff. You pay $50 for 12 months, so you paid, $600, and your family gets $500,000. That's a tremendous protection. And why is that? Because the probability of you dying in 1 year is so low that you can get this huge payoff. The insurance company can afford to do that because most people that they've insured did not die within 1 year. So let's flip that over with longevity annuity. What if you pay one premium today at age 25 and it's only going to pay you back if you make it to age 90? So most people are going to die before age 90, but a small percentage, maybe 5%, 10%, they'll make it to age 90. And they'll get all of the money of the people who died. So it's a small premium and a huge payout, but you have a low probability of getting that huge payout. That's what a longevity annuity is, and I love them. I think they're a great way to protect people from living too long. You did not cover it in paper one. Paper one was talking about immediate annuities. I don't think they mentioned longevity annuities once. So deferred annuity, that's the accumulation side. But what happens if you live too long? So, an immediate annuity has guaranteed payments begin once you hit a certain age, and they can last the rest of your life. Well, that's not what I'm talking about here. What they're saying here, they are somewhat saying this. I don't like this approach. What they're saying is you have a deferred annuity, but instead of starting at age 65, you pay in, but it waits to start paying you until you're 80 or 85. So my problem with this approach is this is too young. I would push back to 90 or 95. We'll see later when we price it. So you part with thousands of dollars for a benefit you may never receive. And that's why the actuaries told me no one would ever buy this. Now, I'll talk about the product I wanted to sell, which combined this with an investment product in a way that both sides look good. You kind of couch it in a way that you're trying to maximize their quality of life between now and the rest of their life. So think about that first article you read on human capital. How can we increase the utility of the alive state and the utility of the dead state, including the utility of living too long? And that's the product I'll show you a little bit later. But this product essentially it's an immediate annuity, but it waits until age 80, 85 to start paying you, much later. But it is a pure annuity. And so if you die, so let's say you pay a premium age 50. If you die between age 50 and 80, you get nothing. But if you make it to age 80, it starts paying you a monthly income. Okay, so that's the way this is set up. So the insurance removes some of the uncertainty about how much you can spend in retirement, because you have this big payoff coming if you hit 80 or 85. So you can more freely spend down your portfolio. You saw that a little bit in Article 1 on the immediate annuities. You have more ability to spend down the rest of your portfolio because you have something there guaranteed to come in. Some companies allow your heirs to receive some or all of your money back, but remember, when you do that, you're actually greatly reducing the power of this product. We don't do that with life insurance. If you buy a 30-year level life insurance and you die at year 31, the insurance company doesn't say, well, you died at 31 after the 30 years, but we'll give your estate some of that money back. They don't do that. So you lose 100% of the money. If you buy a 30-year level term policy and you live 31 years, you lose 100%. I'm arguing with these longevity of products should be the same principle. If you die early, you get nothing, because that greatly increases the power of this. So the pure policy is the best. And I'll show you why I don't like these product policies, because the numbers here look really bad. And the one I will show you looks a lot better. So 65-year-old man pays $18,425, and at age 85, he'll start getting $1,000 a month for the rest of his life. That doesn't sound very good, because someone who's 85 years old, you're getting $12,000 a year. There's a good chance. I mean, it just doesn't sound all that wonderful. For a woman, she would have to pay $23,000. Why? Because women are expected to live longer than men. If you cover both lives, then it's $33,000. It doesn't just add the two together, and we'll actually see the math of that later. If you bought an immediate annuity, you have to pay $211,000. But remember that's 20 years of $12,000. So you're going to get, it just doesn't sound very good. This paragraph, you look at it and say, well, if I pay $211,000, I start getting money at age 65. For 20 years, I'm getting $12,000 a year. That's more than the $211,000 I paid in. That just sounds better. But anyway, you have to worry about inflation. You talked about that in paper 1. Most of these products do not have inflation protection. You have to worry about the insurance company. We talked about that. You're relying on that company being there 15, 20, 30 years into the future. How stable are they? The states do have guaranteed associations which pay you back within certain limits. We'll talk about that a little bit later. If you die too early, your heirs might get some money back, but that's a terrible way to do it. So look how much higher the premium is, $60,000 if you want that kind of protection. This is for a couple, $60,000 versus $30,000 if you want that kind of protection. This is how much you have to pay to get that $1,000 a month starting at age 85. The insurer initially developed a longevity. This is long-term life, New York Life. New York Life. They initially developed a longevity product, but it never made it available because there wasn't much demand. Very much what you saw in that annuity puzzle in paper 1. The thing we have been struggling with is how many investors are farsighted enough to purchase it. I think it's in how it's marketed. These have to be marketed just like you talked about in paper 1. They have to be marketed in terms of quality of life, income. We want to maximize the income during your retirement. You cannot talk about these as investments because there's a high probability of losing 100% of your money, especially if you don't have the period certain. All right, so that's the first article. So trust me, I think I can get you much more excited about longevity products than in this article. I wish I could find a better article, but no one else is seeing what I'm seeing, and it's hard for me to get people excited. But there supposedly is one company doing these type of products, but I don't think it's done all that well. All right, the second article is somewhat of a humorous article. It's a long article, but we're going to go through it fairly quickly. There's this guy named Joseph. I'll just call him Joe because his last name, Cara Madre. It's kind of an interesting name, Cara Madre, but I'll just call him Joe. He studied the variable annuity contracts closely, and he found a loophole in his products. He portrayed himself as a Robin Hood. He's definitely not that, so I don't think this is a good guy. You'll see why. But I don't think he's an evil guy either, the way the insurance industry showed him. Although there are some things he did that might have been a little bit unethical. So he has some legal problems with what he's doing here. The prosecutors say he was unscrupulous con artist. He engaged in identity theft, conspiracy, and fraud. He deceived the terminally ill to make millions for himself and his clients. They said it was fraud, it was an illusion. He often preyed on the sick and the vulnerable. I hate that word. I can never say that. All right, so here's my view. I don't think he preyed on the sick. I think he preyed on life insurance companies, and they didn't like it, and so they sued him. They actually brought criminal charges against him. But here's right out of that ethics question we talked about. The transformation of the life insurance industry away from traditional insuring lives into asset gathering, as we called it. They say complex financial products, right out of our paper 1. See, I don't make this stuff up. So this guy, Joe, said that companies designed the rules. All he did was exploit them. The first case, he did pretty well. The judge agreed that Joe's in contention that he was doing what was in the fine print, that was allowed. He didn't do anything that the policy said he couldn't do. He wasn't defrauding anyone. So what was he doing? Well, these variable annuities have a guaranteed death benefit. What that means is if the market crashes, but you die before the market comes back, your beneficiary gets a lump sum equal to the death benefit or the value of your investment. So if the stock market's up a bunch, your beneficiary get the higher number. If the stock market's crashed, you get the death benefit, and the death benefit is usually how much you paid in premiums. So the insurance industry sold a bunch of these. If you go out and look at Hartford Life Insurance Company, probably you're thinking about auto insurance and property insurance. So Hartford sells mainly property and casualty insurance. So why would I be talking about them when I'm talking about life insurance? Well, they do have a life insurance subsidiary that sells variable life insurance products. And so in 2008, when the stock market crashed, Hartford Life had to set up reserves for the death benefits of their variable life products. So if we go back to 2008, you can see this tremendous fall in stock price, 60-something dollars down to below $10. Pretty incredible drop in their stock price. And why did that happen? This is in the 2008. Yes, it's true they were a financial services company and banks and everybody in financial services was dropping, but not that much. You know, that's like 90-something%, even more than that. They were at $90, not far below that, and they went down. Oh man, I don't know what the actual max min is. 416, so it really got down there. Essentially, the market was saying there's a good chance this company will not survive. So what happened is they have all these variable annuities, and remember, they sold a bunch of them the previous few years. So these people had put a lot of money in, and then the market drops 35%. And so now the death benefit that they're guaranteeing is much larger than the actual investment values that these customers have. And so they have to set up insurance reserves. Well, everyone's not going to die in 2008, 2009. However, when they set up their life insurance reserves, they can't assume the stock market's going to jump back in 2009, 2010. They have to make some assumptions into the future, and so it was really quite complex. And the life actuaries did the best they could, and they had to set up huge reserves. Hartford Life Insurance Company's net worth went very negative because they had to set up huge reserves. It spooked the market. The stock market did not understand it. So even though Hartford Life is a small part of Hartford's business, the market still freaked out about this, and their stock price fell dramatically. So I had someone speak to my life insurance class talking about how insurance companies could protect themselves from this. Oh, and it was just terrible. It was just really did not make sense. It was so expensive to do, and it really did not provide much protection. And he'd written an entire research paper on this. He wanted to share it with the class because he just published this, and I just thought, boy, that's not very, I didn't say anything to him in the class, but I just thought it was not that great protection. So that's the product he's looking at, and so what he's doing here is taking advantage of this death benefit. So if the market crashes but you die, your beneficiaries will get the death benefit. If the market's up a bunch, you get the market. Think about that as a wonderful product. It's a product that says, hey, you either get the upside or you get a guaranteed minimum. That's just wonderful. It's a lot like an equity-linked annuity, except for you really get the upside. So what was this Joe guy doing? What he did is, and since variable annuities don't look at life expectancy, they don't care if you're dying tomorrow or in 2 weeks or in 6 months. They don't care if you buy an annuity. They're worried about that when you buy life insurance. So what he was doing is going out and finding people who were about to die. And he was giving them a little bit of money. He was actually buying the product for them. And he was the one actually benefiting from it. But the people he was buying these products on, it was these people in nursing homes that were about to die. And he said, hey, I'll give you $1,000 if you'll buy this product and make me the beneficiary on it. So they weren't really harmed. They got some money out of it. And what he was getting is he was putting his money into these variable annuities. If the market went up, and the person died, he got the stock market return. If the market crashed and the person died, he got a guaranteed minimum. So he was essentially creating these kind of almost free option strategies, these ways to buy protection against your portfolio for free, and it was huge. It was a really good strategy, and there's nothing in the insurance contract that said you could not do what he was doing. So essentially, how could his clients benefit? Well, you benefit by making sure the person whose life depends on this are about to die. So there's no requirement the investor and the annuitant be the same person. And in fact, remember, the annuitant is the person whose life is in the contract, that is life contingent. So he read the contract, so the annuitant didn't need to have the relationship with the investor at all. So all he had to do is find someone who was about to die, make them the annuitant. The investor could be the one who has all the benefit, all the product, and then you profit whenever the person dies. So just like we said, you get all the upside, you get protection on the downside. And they say from the demise of strangers, but not really the demise of strangers. If he's paying them $1,000 to do this, you know, if I'm on my deathbed and someone says, hey, I'll give you $1,000 if you let me put this annuity on your life, what do I care? It's $1,000 for me. Yeah, sure, go ahead and do it. So I don't know what the demise of strangers, that's what the debate on this is. How is he really harming these people? As competition intensified, many life insurance companies launched a war for customers, and so it's their own fault that they put these things in the footnotes that he could take advantage of. You would think someone in nursing homes that are about to die, that would be a great time to buy a variable annuity, and so people could certainly do that. And maybe that's the complaint they're making, is why didn't he look out for those people in the nursing home rather than just setting this up for his other clients? So there's really no defense. You know, here it says for under $1 million, they don't check the health status. All the companies required for the person was that they had a signature, a birth date, and social security numbers. Companies would ask if the relationship existed between the investor and the annuitant. Joe and the men with whom he worked would either leave the answer blank or type none, and the companies would ignore that. So they were even asking that question, that they could have used that to deny the policy, and they didn't. They still took it. He was honest. So there have been lawsuits filed. One judge wrote down here, is a bit ironic for plaintiffs to suggest they did not know the true nature of the contracts that they themselves had drafted. So Joe usually paid dying persons between $3,000 to $10,000, is even better than what I said, $3,000 to $10,000. How are you harming that person by giving them $10,000? I mean, they could buy their own policy, right, if they wanted to, but they could also do this for Cara Madre, for Joe Cara Madre, if they wanted to. They could do both, and they get an extra $10,000 in one. In fact, they could do this with Joe Cara Madre and take the $10,000 and put it into their own variable annuity if they wanted to. So he thought it was a win-win. Prosecutors charged that he instructed participants in the scheme to lie, to steal identity, to forge signatures. So maybe some of that was going on, and that's probably what got him in trouble, because he did have legal problems. He did get in trouble. So, you know, again, they're saying he was somehow harming these people. You can decide. I had one class, I can't remember what the argument one student made, that they were actually harming him. So you can read, I'll let you read the rest of this. It's a long article. In fact, if you want to, you can just read the highlighted on this. You don't need to read all of it. I'll skip through the rest of this. It is interesting. The grand jury issued a 66-count indictment against Camarade and his partner, and had to go. You know, I think he actually spent some time in jail. All right, we're over time. So what we'll do next class is we will get into the equity-linked annuity mathematics, but we will start by going over options and how options work. You do not need to study that on your own. I'll cover enough on options so that you'll be more than comfortable with them. You might be an actuary student and you think, why do I need to know options? You definitely need to know options if you're an actuary. It's definitely covered on the investment portion of the actuarial exam, but it's a huge part. Life insurance, property casualty insurance are essentially options. Very different types of options than the ones on the markets, but there's a lot of similarities, and so you do need to know them. If you're a finance major, obviously all finance majors need to understand options. So we'll stop it there. We'll get into a fun topic of how could you create your own equity-linked annuity yourself without needing a life insurance company.